And welcome back. It's another big story here for Breakfast Extra. And President Bola Tinubu has signed the Nigerian Insurance Industry Reform Act 2025 into law, marking the most comprehensive overhaul of the nation's insurance framework in 2 decades. The new act repeals multiple outdated legislation, consolidating them into a single, robust regulatory framework aimed at protecting policyholders, boosting investor confidence, and also modernizing the insurance landscape. Key highlights include stricter licensing requirements, higher minimum capital threshold of 25 billion naira for non-life, 15 billion naira for life, and 45 billion naira for reinsurance, risk-based supervision, enhanced consumer protection, and also mandatory licensing for online insurance operators.
Now, the law is expected to deepen the penetration in a market where less than 2% of the population currently holds any form of insurance, while also tackling fraud, enforcing corporate governance, and promoting financial inclusion products. But will this reform accelerate growth and trust in Nigeria's insurance sector, or will it present new hurdles for smaller players and startups? Joining us to break it down is Professor Ken Ife. He's a development economist and public policy analyst. Sir, you are welcome to the program. And very good morning to you. Now,
thank you for having me.
Thank you for being here. The new act is being called the most significant reform to Nigeria's insurance sector in decades. So, I mean, from your perspective, what are the biggest game-changing provisions that are in this law?
Well, first of all, the insurance industry has been underperforming, and the regulatory framework has been very weak. And the compliance has always been an issue. There's complete lack of trust in the industry. And even though finance and insurance account for just under 6% of our GDP, they nevertheless power our growth because they return about 30% growth. So that is very significant. But the fact of the matter is that we need to have what we have just got, and it has been long in coming. What difference will it make? Massive difference. People don't have any trust in this industry. Less than 2% of the population are actually insured, and that should go as high as possible. And if you look at many other countries like Europe and America and all of that, insurance is so critical in enabling growth in the economy and in enabling transactions and inspiring confidence in investors. Investors want to see not only the safety of their money, but all other activities that surround their investment. And only very few of them are actually implemented because only the car is mandatory insurance and then group life that are mandatory. The rest areas of insurance are just not mandatory and people don't care. But now, if we faithfully implement this, it will begin to return confidence into the economy, and then the investors will embrace this. And you will see massive growth in insurance.
Professor, in terms of a layman now who is hearing this information, if there is a playground type explanation that you can give for the layman, for the common person, how does this help him? Now, you say that only about 2% of Nigerians are insured. What would it make insurance more expensive for the common man, or would it just make it more accessible? How does this help him?
Well, as really to enter into the fray, then the economies of scale will kick in, and it is competition. In fact, what drives prices down is competition, and what helps competition is transparency, and then trust. All of these are lacking in the previous regime, but they are all likely to now kick in. The fact of the matter is this regulation is consumer-centric in its focus. So it looks at the consumer first and foremost. For example, why is the banking industry powering above their weight? It's because of the strong regulatory stance of a central bank. There are prudential guidelines. There are risk-based supervision, which they do monthly with NDIC. Now, when people who are personally insured, when they have issues, for example, if the insurer goes bankrupt, there's no protection for them. Now there is. But if you're a deposit insurer in the banking sector, if anything happens to the bank, the NDIC kicks in. Analyst gives you 50%. Now you are beginning to have the equivalent of NDIC in the insurance sector. And there are many more things that are going on there. Is that asking for it to be digitalized? All aspects of the insurance value chain to be digitalized. When I drive my car in the UK, once the police car sees your car, immediately it tells whether you've insured, whether you've done MOT. There's so many things that are so automatic. If you make phone call, you can get there. We don't even have KYC in that sense, because everybody online is giving insurance, and then that's why people, in fact, if you look at our car industry, people only care for the mandatory, which is third party and theft. They're not interested in the comprehensive, because they know they're never going to get paid if their car have accidents. So they just take the minimum required by law and then they move along. You hit their car, they continue their journey, because they know it's going to be a waste of time to go for insurance to pay them the damage. So but all of these are going to change. They are actually going to change.
Now, so Professor, so
and second problem.
Go ahead, please.
Second problem is the capitalization, the capital structure. The capital requirement for the players is so small that I don't blame them. They run away from bills. Now they have a higher minimum capital requirement of 15 billion for non-life and 10 billion for life, and as well as 35 billion for reinsurance. So there is this coming up. That's the same thing as we're having in the banking sector, where they are now heading out to 500 billion naira minimum capital requirement. So Professor, they should all work together, because they're all part of the same structure. So Professor, and they are the common denominator of our industry.
My apologies, Professor. So I just didn't want you to go too far regarding these capital. Does it make it more? Does it make it easier for investors to come into the playing field?
It does. It does, because you see, what do investors consider? First of all, don't forget that there are investors that could come into the insurance industry. They are now going to be interested in coming into the insurance industry, to invest in the insurance industry, because they can see transparency, they can see accountability, they can see honesty play its part, and people can see quality of service, digitalization of services, everything that is required to make insurance and protecting the insurances themselves, so they can see all that, so they can confidently go and invest in insurance company. Then the second point is, how about the people taking insurance out on whatever that, you know, in America, 30% of people's income goes to health insurance. 30% of their income goes to health insurance. And I don't know how much it is here, if there is. Anyway, so you can see that on the side of the people who are coming with the business to insure their business, it is not just car and group life. There are thousands of things that can be insured. There's building insurance. There is even transactions. You have, even when our companies, when we tender for contract in UK, we are required to produce public liability insurance, which means that the public facing area where people come to public building have to be insured. And the people coming in to use this service will have to be insured. If anything falls on them, they have to be insured. You have to have employer liability insurance. Those you employ are insured. If anything happens to them while they're working for you, then you have also professional indemnity insurance. If people give you advice, professional advice, lawyers, accountants, all of that, they are insured. You are insured, because if anything goes wrong with their advice, then you sue them. So there are thousands and thousands of things, shipping lines, transportation. You are transporting your goods from Lagos to anywhere, they are insured. If anything happens, then that means that many of these insurance companies will not insure the transit if the cars are not MOT'd. In other words, if they are not roadworthy, they will not agree to give insurance. So that forces the transportation industry to update their cars, to make sure that their cars are roadworthy. So it has a ripple effect.
Right. Professor,
so it's very, very important protection.
Right. From your description, it seems like the insurance sector has been coasting for quite a while until this, enactment, or rather this signing of this act into law now for the insurance sector. And, this recapitalization, one would say, or capital requirements as now needed from the sector. But what about implementation? How would this, ensure consumer protection? Because, like you said, there's been a trust deficit between the customers, the consumers, and the insurance sector. How are you going to ensure that, you know, that the consumers are met and, you know, they win back the trust again? And in terms of compliance, will this enhance the sector, you know?
Absolutely. Let me tell you the lacuna in our law.
Go ahead.
The thing is that our laws fail on implementation simply because we don't have penalty clauses against infringement. We don't have enforcement rights. We don't have mechanisms. And we don't even include, apart from fines, include imprisonment. Now, I can tell you that we've done that now on Revenue Mobilization and Fiscal Commission Act of 2025. We've now done the same in Insurance Act reform. We have not done the same in Fiscal Responsibility Act 2007, which is what governs borrowing and public sector finance management. That is the one that is missing. Once you have them, it means that the NICON is empowered to take action, revoke licenses, sue, take action against some infringement of the person. Somebody look at the fines. Already we have fines for 25 million if you individual, or even 50 million for firms for violating. So they will enforce those because they have enforcement powers. It's not like in Fiscal Responsibility Act where you have to write report and you take it to the Attorney General and it will sit in one locker there for years. That's not the same. Now these two laws can actually bite. And when one or two people go to prison because of infringement, people will sit up. When companies pay those fines, you're no longer telling us corporate manslaughter. No, if you have corporate manslaughter, a principal officer is going to jail because that's what the law says. It has a provision for not only 50 months, but plus 2-year imprisonment. So it's not going to disappear. Oh, corporate manslaughter. No, it's serious. But now, when you have those law, enforcement becomes possible. And then that's what happens with central bank. Notice that central bank fines companies and makes hundreds of billions of naira from fining these banks. The same thing with Nigerian Communication Commission, where they fine the digital companies, then there is order, there is respect. Somebody breathes down their shoulder. And when you have online, when you complain, the complainant gets immediate response because NICOM will look at immediately they will look at the audit trail. They will look at the digitalization infrastructure of the insurer and they can tell. Just like central bank can tell when you are complaining to them, they can actually go to the console, they can actually see what the bank has actually done. Mm-hmm. So that is what its implementation becomes easier because you have regulations and then you have laws, you have penalties, and you have enforcement.
All right. So, sir, with all of this enforcement, regulation, and all, it helps investors come in. Competition brings prices down. But with the neglect or rot that the insurance industry has been left in for the while it has been left in, how long will it take before we begin to see change? And I mean actual change.
Well, it still comes back to the question that people want to see value in whatever they're spending their money. Mm. Right. But the law takes immediate effect.
Right. So let's talk about that minimum capital requirements, right, that you reeled out earlier. 25 billion naira for non-life, I think about 15 billion for life, 45 billion for reinsurance. And we're talking about capital. 15 million. We're talking about, competition. We're talking about entry. We're talking about sector. Will these numbers, this figure, not sort of make it harder for smaller insurance company as entry into the market?
No, it's not the point. The point is this. Don't forget, Nigeria had 81 banks in 2005. Right. But when the central bank governor went to South Africa, 2 South African banks had more capitalization than 81 banks in Nigeria. So they went to the capitalization. So they moved from 2 billion to 25 billion. Yes, some of them went through the way, but they didn't. They were taking over the mergers and all of that. The important thing is to bring confidence, bring strength, bring regulation into the business so that people can embrace the industry. The industry will grow. And then others will find their way. But the thing is that you cannot say, oh, we want to protect 1,000 insurance. No, that's not the point. The point is, what do you do, the minimum requirement to get people to patronize this industry? How do we allow this industry to play a meaningful part in enabling growth in our economy? Right. People cannot invest in your economy because they don't see how they can be insured, their risk can be insured.
Okay.
Anything financial requires risk. If you have risk, you have to have insurance.
All right.
Professor Ken, I must say thank you for taking out the time to join us. It's been quite stellar. It's always great having you. Professor Ken Ife, he is a development economist and public policy analyst. Once again, sir, thank you for coming on.